let me share with you everything I think you need to know about bonds, both the theory side of it as well as a pivot into the practical side of how you can use information about corporate bonds to better your investment thesis, starting with the theoretical side of it. Now, there are two types of bonds. There's the American version and the European version. And the European version will continuously pay out yields on different dates, while the American type of bonds will pay out only at maturity. Maturity means the end date of the bonds. All right, this is the date where debt holders are being repaid by the company. In terms of the American bond, it will usually trade at a discount if there's quite a few years to maturity, then discount can be even heavier. And this means that, let's say at the end of the period, you get paid $100, all right? This is 3 years down the line, and you want to buy this bond today. Well, money in the future is worth less than money today. So the bond will be traded at the market for, let's say, $95. All right? So you pay $95 today, and then in 3 years' time, you get paid out $100. And if the bond is trading for 100 today, and then in 3 months when the bond matures, you'll get paid $100, then we say that the bond is trading at par. And when you do business school, you will do a lot of, quite frankly, boring calculations on the net present value of a bond, where you look at if there's yield, you discount that yield into today's money, net present value, and you also calculate in the default risk, the bankruptcy risk here, where in case of the company going bankrupt, you calculate that this will cause you to lose 60% of your investment, all right? And then you multiply that with the risk of bankruptcy, and you basically take this into your formula as credit risk. Those are what you will learn if you go to business school. But what you can actually use your knowledge of bonds for when you do your investment thesis is you can use it as an indicator of how solid a company's operation is. And if you remember a previous video on this channel where I talked about how AMC was overvalued, I took a look at bonds with a maturity 5 years into the future, and we could see that these bonds were trading at about 60 something percent of the value the bonds would have at maturity, right? So let's say they pay out $100 in 5 years, you can buy them today for 60 something dollars. And what this tells me is that the market is pricing in a great risk of future bankruptcy. So the wider this gap is, the greater the risk of bankruptcy, the less solid the market thinks that this company is. Now, we call it trading at par if the bond is trading at 100 and maturity is 100, right? So the closer it is to par, the more stable the market thinks that this company is, all right? So that's one way you can use your bond knowledge in practice. And the second way is that you can study the terms of these credit agreements to learn about future events that could trigger big price movements in share price. Remember one of the videos where I talked about Huang LNG, the third and fourth bond that they issued, had legal obligations tied to them that said that the company could not pay out dividend from the cash flow that they generate from one of their shipping charters. And this means that the debt holder, creditor holders, bond holders wanted to secure that they get paid first, as this was a bond paying out I think it was 6% something on a yearly basis. All right, so they wanted to secure that yield, secure their investment to basically give more credit financing. So this term was tied into the bond, and basically, if a credit event happened, then this company Huang could continue to pay out dividend from the cash flow, and this dividend has the potential to greatly affect the stock price. All right, so those were the second type of practical information that you can use when you study bonds. I hope this knowledge helps you better your investment thesis and make a ton of money with every investment you decide to make. Take care now, invest safe, bye bye.